In this video, we will work problem 2.9a, looking at the effect of transactions on the accounting equation. So 2.9a says J. Pembroke started a business. During the first month, so April, and we'll always assume the current year, 2020, the following transactions occurred. So you're given transactions A through G, and down below, what you're required to do, it says show the effect of each transaction on the individual accounts of the expanded accounting equation. You remember the accounting equation is assets equals liabilities plus owner's equity, but then we expanded it to include the other elements that affect owner or make up owner's equity. So it would be your capital account minus drawing plus revenues minus expenses in the expanded accounting equation. And then after transaction G, report the totals for each element. Demonstrate that the accounting equation has remained in balance. So if we come over and let's look at the work paper, and I know you guys are going to be working this on the computer, but if you were working it with our working papers, it would look like this. So we have our accounting equation, assets equals liabilities plus owner's equity. And if you remember, as we discussed in the chapter, your assets are broken down into accounts. So these are all of your assets. Cash, accounts receivable, supplies, prepaid insurance. Those are the accounts that we'll need for this problem. And we have one liability account that we're going to need for this problem, accounts payable. And then here are your accounts that make up owner's equity. You have capital minus drawing plus revenues minus expenses. So just want you to understand what we're looking at here. So let's go back. Just a couple of reminders. Remember that each transaction affects at least two elements in the accounting equation. So each transaction affects at least two. It can be more than two, but at least two. And that the accounting equation must always remain in balance. So for every single transaction that you record, after you've recorded the transaction, assets should equal liabilities plus owner's equity. That should always be true. Okay, so our first transaction says invested cash in business $18,000. So J. Pembroke took his money, and invested cash in the business. So what accounts are affected when an owner invests money in the business? The two accounts that are affected by this transaction are cash and capital. When the owner invests money in the business, the accounts that are affected are cash and capital. Now, what kind of account is cash? Cash is an asset. What type of account is J. Pembroke Capital? It is the owner's equity account. So I want you to get in the habit of identifying the accounts that are affected and then further identifying which element those accounts fall under. So what is happening to the cash of the business when J. Pembroke invests in the business? Well, the cash of the business is increasing by $18,000. And what's happening to the capital account when J. Pembroke invests? It is increasing by $18,000. So for transaction A, we have an increase to cash for $18,000 and an increase to J. Pembroke Capital for $18,000. And after you've recorded each transaction, ask yourself, does the accounting equation remain in balance? So our assets are $18,000 And then we have liabilities, which are 0. I'm going to plug in this plus sign right here that I forgot to include. So for this side of the equation, we're going to have liabilities plus capital minus drawing plus revenues minus expenses. Okay, so that all we have on this side so far though is the 18,000. So this side of the equation totals 18,000. So 18,000 equals 18,000. The accounting equation remains in balance. And that just moved that away. Okay, so then let's go to transaction B. Transaction B says bought office supplies for $4,600. So we are receiving office supplies, $4,600 in office supplies. We paid $2,000 in cash for those supplies, and $2,600 was on account. So think about it. You go down to the office supply store. You're getting $4,600 in supplies that you're going to take with you. You hand them $2,000 in cash. The other $2,600 is on account. And if you remember, as we went over the chapter, I said on account means that that cash is not affected by that part of the transaction. Is it accounts receivable though, or accounts payable? Think about what's happening. If you are getting $4,600 in supplies, you're giving them $2,000 in cash, you owe the other $2,600. You're going to have to pay that $2,600 in the future, right? So that would be accounts payable. So the accounts that are affected in transaction B are cash, supplies, and accounts payable. You have 2 asset accounts affected and 1 liability account. Again, I just want you to always analyze it in detail. So what's happening to cash? Cash is decreasing. We paid $2,000 for those supplies. So we would have a decrease to our cash account of $2,000. What's happening to supplies? Supplies is increasing. We now have $4,600 in supplies. So supplies is increasing by $4,600. And the last account that we said was affected was accounts payable. Again, accounts payable represents amounts that you are going to have to pay in the future. And so accounts payable is increasing by $2,600. We're going to have to pay $2,600 in the future for those supplies. Now, on your calculator, in your head, however, it's always good just to double check and make sure that the accounting equation remains in balance after each transaction. Does assets equal liabilities plus owner's equity? So even though there's not really a space, I'm gonna look at these total here. 18,000 minus 2,000. So our total in cash right now would be 16,000. Okay, our supplies total is 4,600. So that's all of our assets. So basically this is what we're looking at. Because accounts receivable is 0 and prepaid insurance is 0. So 16,000 plus 0 plus 4,600 plus 0. So our total assets at this point are 20,600. So here's our equal sign. I'm going to bring that down. And then we have the second half of the problem. We've got 2,600, I'm sorry, plus, so there's the plus sign, plus 18,000 minus, see the minus sign, minus 0, drawing a 0, plus the revenues are 0, minus 0 for expenses. So basically what we have here is 2,600 plus 18,000. So this side of the equation totals 20,600. So the accounting equation remains in balance. Assets equal liabilities plus owner's equity. Now I'm just doing that so you can understand what's happening. So again, I'm not sure on the computer if it's allowing you a line for those balances after each transaction or not, but it's just a good habit to get in, make sure that the accounting equation remains in balance before you move to the next transaction. Because if you wait until you get to the end and then realize that it's not in balance, it's going to be more difficult to determine where you made the mistake. Okay, so transaction C says paid 1 year insurance premium $1,200. Paid 1 year insurance premium. So you're paying for insurance in advance. And if you remember, as we went over the chapter, insurance paid for in advance is an asset, and we call that asset prepaid insurance. So we are getting prepaid insurance. And the reason it's an asset is because there's future benefit there. The definition of an asset was something that the business owns that is going to provide future benefit. If we were just paying for 1 month of insurance, then there would not be future benefit. It would not be prepaid insurance. But since we are paying for it for months in advance, it is an asset. The other account that's affected here, what are we paying them for this insurance? We're giving them cash, right? So the other account that is affected is cash. So it's 2 asset accounts that are affected by transaction C. Can you have 2 asset accounts affected? Sure you can. All right, so what's happening? We'll start with cash. Look back over here. We're paid 1 year insurance premium for $1,200. So what is happening to cash in that transaction? You're paying out cash, so it is decreasing by $1,200. So that is a decrease of $1,200. What is happening to prepaid insurance? It is increasing. We are receiving $1,200 worth of insurance, so there is an increase to prepaid insurance. And then of course you would make sure that the accounting equation remains in balance. So I'm not going to do that each time, but you compute the balance here. It'll be 18,000 minus 2,000 minus 1,200. This will still be 0. This would be 4,600, 1,200. So you would get this side of your equation, the assets. Then you would calculate this side of the equation. So it would be accounts payable plus capital minus drawing plus revenues minus expenses. Again, I'm just trying to, it's much harder to teach this on the iPad than if we were in person, but that is what I would like for you to get in the habit of doing. Okay, so let's move on to transaction D. Earned revenues totaling $3,300, $1,300 in cash and $2,000 on account. So let's think about what's happening here. Earned revenues totaling $3,300. You went out and you worked for your customers and you earned revenue. So you did $3,300 of work. Not all of them paid you though. You only received $1,300 in cash. The other $2,000 is on account. Okay, so what does this on account mean? Well, if we go out and we work for someone, we are earning revenues, and they do not pay us, we earn them on account, well, we expect to receive that money in the future, correct? So money that you will receive in the future is accounts receivable, and accounts receivable is an asset. So far, we have said cash is affected because we are receiving cash. We've said accounts receivable is affected because you're going to receive the part that hasn't been paid to you yet. We're going to receive that in the future. The third account that is affected here is going to be a revenue account. And your revenue accounts are also going to have specific titles, just like your assets do. You have your asset cash, your asset accounts receivable. Your revenues are going to be broken down too into specific account titles. For this textbook, if it doesn't tell you exactly what kind of business it is, for example, in this one, it just says J. Pembroke started a business. It doesn't tell us what kind of business. So we will call our revenue account service fees. And for right now, when we have a revenue or expense account that is affected, we're going to come over to this description column and write the account title. So service fees. So we earned, if you remember, we're back over here, we earned $3,300 in service fees. So our revenue increased by $3,300, the amount of service fees we earned. We received $1,300 in cash. So the amount of cash for our business is increasing. We received cash, so cash is increasing by $1,300. And then we also have $2,000 of accounts receivable, amounts that we expect to receive from those customers in the future. So in this transaction, transaction D, there are actually 3 accounts that are affected. Is that okay? Yes. We said that at least 2 accounts, but it could be 20 accounts that are affected. It's just at least 2. So yes, in transaction D, we had 3 accounts affected. Cash is increasing by $1,300. Accounts receivable is increasing by $2,000, and service fees, the revenue account, is increasing by $3,300. And then you would make sure that the accounting equation remains in balance, and then we would go to transaction E. Transaction E says pay cash on account to the company that supplied the office supplies in transaction B, $2,300. Okay, a big hint. If you see paid on account, you do not need the rest of this information. You do not need any of that. If you see paid on account, you know that the accounts that are affected are cash and accounts payable. Because what does paid on account mean? It means you're paying someone what you owe them. So we paid $2,300 on account. Remember, accounts payable is amount you owe others. So when you pay on account, accounts payable is going to decrease because you're paying them what you owe them. So the amount that you're going to have to pay them in the future is going to be less, right? So we paid $2,300 on account. That will decrease accounts payable by that amount. And what's happening to cash if you pay it out? It is also decreasing. So for transaction E, we had a decrease to cash for $2,300 and a decrease to accounts payable for $2,300. And then you would make sure that the accounting equation remains in balance. Then we'll move on to transaction F. Paid office rent for the month, $750. So you're paying the rent for 1 month. No future benefit there, right? It's just an amount that you incur in order to operate your business. You have to have a space for your business to be located, and so we have to pay the rent each month. So the two accounts that would be affected by this transaction, of course, cash, when you pay out cash. The other account that would be affected is an expense, rent expense. And if you remember, I told you anytime that we have an expense account that is affected, for the working papers at this point, then because they didn't divide it into the different account names, we're going to have to come over to the description column and write the exact account. So we wouldn't write paid rent. We need to write the account title. So it would be rent expense. And we paid rent expense of $750. So the expenses are increasing by $750. Rent expense increased by $750. And we paid for that rent using cash, so our cash is decreasing by $750. And then you would make sure that the accounting equation remains in balance. I am going to do that with you after this next transaction, so we'll get one more practice doing that together. Our last transaction says withdrew cash for personal use. So the owner took $100 of cash out of the business for personal use. And if you remember, as we went through the chapter, when the owner takes money out for personal use, it is drawing. So the two accounts that are affected in this transaction are J. Pembroke drawing and cash. Now, if he's taking cash out of the business, then of course the business's cash is decreasing. So that's a decrease of $100 to cash. And capital, anytime the owner takes money out for personal use, it is an increase to the drawing account. So J. Pembroke drawing is increasing by $100. Once you have all of your transactions entered, then we need to, again, make sure that the accounting equation remains in balance, and the problem required you to prove that it is in balance. So we need to calculate cash first. So we take all of our transactions for cash. We would say 18,000 minus 2,000 minus 1,200 plus 1,300 minus 2,300 minus 750 minus 100. We would calculate the ending balance of cash to be $12,950. Then accounts receivable. There's only one transaction there, so the balance would be $2,000. Supplies, there's only one entry there, so the supplies balance would be $4,600. Prepaid insurance, only one entry there, so it's a $1,200 balance. if we add all of our assets up, then we get $20,750 in assets. All right, so I'm just bringing this down. So here's the equal sign, and we'll total up accounts payable. So we had 2,600 minus 2,300. So the ending balance for accounts payable is 300. The ending balance for capital, we only had the one entry there, so that is 18,000. For drawing, we only had the one entry, so the ending balance for drawing is 100. We only had the one entry for revenues, so 3,300. And then we only had the one expense, so that would be 750. Okay, so then we need to calculate the balance for this side of the equation. Remember that this side of the equation is liabilities plus owner's equity. Remember, accounts payable is the liabilities. All of these others make up the owner's equity. Now, how do we calculate this side? Well, these symbols really make it easy for us, right? I'm just going to bring that plus sign down. So 300 plus 18,000. Here's a minus sign in front of the drawing. So this is minus the drawing of 100. There's a plus sign. I'm going to bring that down. So it is plus the revenues and then minus the expenses. So I'm bringing that minus sign down. Okay. So then we have 300 plus 18,000 minus 100 plus 3,300 minus 750. So that will make this side of the equation total 20,750. So the assets equal liabilities plus owner's equity. The accounting equation remains in balance.